Hi folks, if you're an investor in the Indian stock markets, then you would have noticed that the markets have fallen significantly. The Nifty 50 has fallen by about 13% from its all-time high in September 2024. Indices in the other categories have also fallen. The mid-cap indices have fallen by about 20%. The small-cap indices have fallen by about 25%. The Nifty Next 50 has also fallen by about 23%. To add to this, the Nasdaq has fallen by about 13% in the last few days, and even Bitcoin seems to have taken a hit, falling by about 23% from its peak highs. For many investors, this could be the first real market fall that they are facing, and it can be scary. What has happened in India is that most asset classes saw a rise in value in the last few years, that is between 2021 and 24. Whether it was gold, property, or stocks and mutual funds, everything was going up. So this was a very good time for the Indian public. Now, the fall has started, at least in the equity markets, especially if we have apps which show us the XIRR or annualized return. The fall seems even greater because the annualized return is extrapolated on the absolute return. For example, if your fund value has fallen by 5% in the last 3 months, your app could be showing a fall of 20% annualized. At this time, a lot of unwanted thoughts and advice also comes to us. We may think that if we had invested in a fixed deposit, by now we'd have been sitting at least 5 to 7% gain. Other half truths like property and gold never fall in prices, real estate always gives a steady return, or it's dangerous to invest in stock markets. All these thoughts come to us and make us want to run away with our investments. However, it is important to remind ourselves of the first principles of investing in stocks and in equity oriented funds. Firstly, these investments are for long term goals. You probably may not need them in the short term. In case you're facing a medical emergency, then you can use your health insurance to offset any payments that come from there. If it is a non-medical emergency, then you can withdraw from your emergency corpus, which will be placed in either a fixed deposit or a debt mutual fund to pay off this amount. In case you haven't taken these measures, it's important to start doing so immediately. Having a financial cushion allows you to ride out volatility and not give in to panic selling. Secondly, any profit or loss which is showing is on paper. It's not real until action is taken. That is, until you redeem the funds. So, a temporary dip in the value does not equal to a real loss. You can wait it out and see the direction of the funds and then take a call as required. Another point to remember is that mutual fund schemes are managed by professional fund managers. They are professionals with the knowledge and expertise. They have teams of researchers and analysts, and this helps them to manage the volatility in a better way than we could. This also helps the scheme to be aligned to our long-term goals. Having a well thought out redemption plan also helps. This means that we don't get emotional and panic and start redeeming our holdings. Instead, we take it out when required after the funds have met the desired goals. Knowing when and how much to withdraw at what levels is very useful in making the right kind of exit. Also, remember that when markets are rising, it means that we are investing at higher cost per unit. While this cannot be controlled and it is important to continue our SIPs, but when markets dip, that means that now our SIPs are helping us acquire units at lower NAV or net asset value. This helps us to average out our cost over time and gives us better returns. Last but not the least, remember that equities as an asset class helps beat inflation. Over the years, equities has shown that the returns consistently beat inflation, and by leaving our investments untouched, it helps us to gain the advantage of compounding. By keeping these fundamental principles in mind, we can avoid being swayed by the market movements in the short term and all the noise that comes along with it. This helps us to stay invested for the long term and use these funds appropriately to meet our long term measures. So I hope this video helps you in your investment journey. If you have any queries, do write into us or drop a comment. Thanks for watching.